Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update about the economy and the investment market so you can better your portfolio. Today we've got something a little different for you. We're actually going to talk about something that I talked about on my show on Sunday, and also an area that we continue to get a lot of questions from potential new clients and our radio listeners alike. I'm going to cover 6 devastating investment mistakes that I typically find most retirees and pre-retirees make within their portfolio. The first mistake that I find is really not having an investment strategy or following it. And I know what you're saying. If you handle your own money, you need to make sure you actually have an investment strategy in writing and it's being followed. An investment strategy is just like a roadmap to get to where you want to go, or a recipe to make something that you want to bake or cook in the kitchen. If you don't have one, it's not going to come out correct. You're going to take more risk and you're going to make less returns. The other side of the equation, if you're using an advisor, most advisors are acting really as a broker and not a money manager. They would not have an investment strategy either. If you want to know if your person has an investment strategy in writing, ask them for a copy. If they cannot easily produce an investment strategy in writing, it tells you right off the get-go nothing's ever been followed, and unfortunately you're taking more risk and have less return. Number 2, letting emotions ruin your investment decisions. Emotions are going to wreak havoc on an investment portfolio. Everybody has emotions, and unfortunately, that's not a great way to manage your money. If you had an investment strategy and you followed it, it would help you curtail risk and help you find opportunities for income and growth, whether you're a pre-retiree or retiree. Taking too much risk and not taking enough adequate risk during retirement. Bottom line is this: if you don't take a reasonable measure of risk, you're not going to have the chance to make any real return, and your portfolio is not going to get ahead of inflation. Number 4, putting trust into questionable advice from your broker or so-called advisor when it clearly has not worked in the past. Why would it work in the future? I can't tell you how many emails and questions we get about my person calls themselves an advisor, Brian, or they're a wealth manager. Are they not managing my money? The answer 90% of the time is often absolutely not. Just because they have a fancy title doesn't mean they do what you expect them to do. And that's why I always encourage people to use our fiduciary questionnaire, which gives you 12 simple questions to determine, do you have a real investment manager? And are they working in your best interest? And are they in charge of babysitting your money? Number 5, over diversifying or holding investments that are not appropriate in today's cycles. I'm going to talk a little bit about that later in this conversation, and I'm going to show you some ideas. 6, not having a risk reduction strategy and not cutting your losses when you clearly should, meaning buy and hold. Let me flip to the next screen here, and you can clearly see, and this is a little napkin that we've written, and on your left side, when you know there's a problem, when your investments are not doing the right thing, when they're going down, this is what I call the emotional stumbling block for most investors. When you know there's a problem on the left, and on the right, when you do something about it. The space in between is what costs you substantial losses in your portfolio, regardless what you invest in. Okay? So the key here is what you're trying to do with an investment strategy is curtail risk. If you have risk reduction built into the portfolio, you should not be seeing 30 and 40 and 50% declines in your portfolio. If you have in the past, what that tells me is there is no risk reduction built into your portfolio, and you're probably not getting any real advice at all. Let's take a look at this chart. One of the strategies I use are market trend indicators that I talk about every week on my show and are published in our newsletter. Our intermediate market trend indicator, if you just use that, a simple 200-day moving average, and if you've never got this advice before from your broker, so-called advisor, it again reiterates that your money's probably not being managed at all. This is Bank America. We had a clear signal to sell Bank America using our simple market trend indicator back when the stock was trading around $45 a share. Today the stock trades at $7 a share. you would have, by just following this simple risk reduction strategy, reduced risk in a stock like this by over 80%. Let's take a look at another stock, Exelon, a utility company. Clearly showed a sell around $70. Today, that stock trades around $40. Here's another stock, Citigroup. Clearly showed a sell around the $50 mark. Today, that stock trades around $5. Reverse split adjusted, of course. Here's another one, and I've talked about natural gas as a possible investment, not now, but when our market trend indicators dictate and when it's relatively strong. Here's natural gas that used to trade and had a clear sell signal around $90, now trades at around $8. So again, every investment you buy, whether it's a stock, a bond, real estate, market trend indicators can clearly give you decisive, non-emotional ways to reduce risk. I'm going to ask you a simple question. Do you have a decisive way to reduce risk in your portfolio? Are you using techniques like this to reduce risk in your portfolio? By the way, this would be part of an investment strategy. If you don't have an investment strategy in writing that you can easily produce, unfortunately, you're flying by emotions, and so is your advisor or so-called broker, because again, the role is not really to manage your money. Let's talk about over-diversification. This is one that Wall Street clearly has a lot of investors bamboozled, in my opinion, works. Asset allocation is a simple concept. What they tell you is buy 10 different distinct asset categories, invest in all 10 all the time, put 10% in each one, and rebalance those accounts once or twice a year. The problem is you're owning the good with the bad. If there's clearly not assets you should have in your portfolio, why would you own them? Only own the good ones based upon relative strength and market trends, and disregard the other ones until they are appropriate for your portfolio. The best way to explain it is like golf. If you're a golfer, you have 14 clubs in the bag. 13 clubs and a putter makes 14. If you had to go to a golf course and evenly use each club every single time, how good would your score be? You'd be forced to use clubs that are not appropriate for the course you're on, so that means your score obviously would be worse than better. Think about your portfolio the same way. Your investment strategy should dictate which investments you should be in at when it's the appropriate time. That's what our Global Tactical Opportunity portfolio does, and I'll tell you, year to date, it's doing phenomenally well. One of the things that happens to too many investors is you have assets in the portfolio that are not appropriate in today's cycle. There are times you do not want to own stocks. There's going to be times you don't want to own bonds or real estate or any category. The key is which asset categories are appropriate today. Those are encompassed in your portfolio for upside in income and diversification. The ones that are clearly not in or should not be in your portfolio today should be left out. ResNey Wealth Management, our Global Tactical Opportunity portfolio. We get a lot of questions on this. Because we're an actual money manager, we actually have a written investment strategy, which if you'd like a copy, you can call our office. We'd be more than happy to give it to you. And it details how we manage a portfolio. We do something called relative strength. We look at market trends and relatively strong sectors. We look at all major asset categories around the world, but only encompass the top 5 leading ones in our growth portfolio on any given month or any given quarter. What we do is we want to have a diversified portfolio, but we don't want to clutter the portfolio with asset categories that are clearly not appropriate today. We've seen a substantial rise since year to date in our global tactical portfolio. It's designed to mitigate risk, reduce risk and volatility, but still provide income and growth and be in the appropriate categories when necessary. So the bottom line is we look at all sectors, but unlike a asset allocation approach where you own the good and the bad, which waters down return and actually creates more risk, we want to be in the predominantly strong sectors. Look at it this way. Assets, any category, whether it's stocks, bonds, real estate, cash, it doesn't matter. Investment asset categories are either going up or they're going down. Own the top 5 producing categories. That's our strategy. And when one of those 5 categories falls off because there's a relatively stronger one in the bottom 18, it gets replaced. So this way you've got an adaptive strategy that's progressive as market cycles change. You're not putting your emotion or your personal bias into it. You're using a detailed strategy, not only that has worked in the past, but will give you an opportunity to work in the future. The best advice I can give investors, and I talk about this often on my radio show, don't expect to get different results if you keep getting the same questionable investment advice or keep investing in the same questionable investments and following or not following an investment strategy that clearly hasn't worked. If what you're doing today hasn't worked in the last 3, 4, 5 years, or 10 years, you're no further ahead. You go up, you go down, you go up, you go down, and you're not gaining any traction, and you still get the runaround. It's time for a change. You clearly do not have an investment strategy, or certainly one that's working. If you want to get different results, you need to change what's not working within your portfolio or the advice or strategy that you're currently deploying. Let us help you. We can help review your investments in portfolio and retirement strategy. If you don't have one, we can help design one that's right for your goals and objectives. Schedule an appointment with my firm, Resney Wealth Management. We like to work with nice people who want to build wealth and want to preserve their wealth and grow their income for retirement. If what you're finding is not working, you'd like to sit down in a comfortable setting and talk to our firm about how we are different, why we have a different strategy, and how we can help you without the conflicts of Wall Street and without sales, commissions, and in your best interest. Call our office. We'd love to sit down with you, review your portfolio, and talk in detail how our strategy works and how we can get you back on track. Make sure you do listen to this Sunday show and have yourself a profitable week.